Well, hello and welcome once again to another Tuesday evening. And I'll just put the pre-show on just to show that we are not yet fully on the main show, but great to see everybody on tonight. And Happy New Year to all of those, the regulars and any new that have joined us this evening. Great to see you here for the first show of the new year. And I also should explain that we've got a thunderstorm going on here in Sydney at the moment. Well, Wollongong. And as a result of that, Meteor, the smaller of the two dogs, is under my feet at the moment, hiding from the thunder. She doesn't like the thunder at all. So, and if the thunder gets too loud, she'll start barking. So we might have a few interruptions, but hopefully we can work around that. At the moment, I'm rubbing her ears with one hand while I'm talking. Try and distract her from the noise. She does not like the thunder. In fact, try and take her out for a walk. She spends a lot of time barking at the thunder and annoying the neighbours. So, whereas Meteor doesn't seem to care at all, as you saw in the pre-show. Anyway, we've got a good chat this evening with Damien, and a lot to talk about. Of course, new year, new investment scenarios, but how new is it relative to last year? And a bunch of other things we're going to talk about too. So without further ado, let me take that off, and I'm going to play my intro and then we'll get going. Well, good evening and welcome to this live stream on the 3rd of January 2023. Martin North from Digital Finance Analytics here. Great to have you on the show this evening, and thanks for taking some time out of this Tuesday. Busy time, of course, just after New Year, and people are still off or going back to work and all sorts of things. So great to see you here tonight. Just before I bring Damien in, let me just remind you that we don't provide financial or legal advice on the channel. It's a general conversation only. The chat is moderated. Do encourage you to make your views known in the chat, and very interesting to see some of the conversations. I don't promise to follow all of them. As at the 3rd of January, of course, if you're watching replay, use that Walk the World if you'd like to get my attention. And if you've got a question you'd like to ask, use at Walk the World. That then puts it into a different queue. And as I was explaining to Cookie Boy, I do have a separate queue for the questions. The trouble is that the queue gets a bit long, and sometimes I lose stuff off the top. So if I do, and the question doesn't get noticed, ask it again. I've also enabled Super Chat, which means that you can get your question on top of the list, but also make a contribution to what we do here. And all those contributions are gratefully received. Helps to cover some of the costs of what we do. Anyway, with the thunder going off in the background, like you wouldn't believe, you may be hearing it coming through in the background there. I'm going to bring Damien in and see whether we can bring him in and start the conversation. Damien, are you there? Yeah, have you muted yourself?
I did too. How's that?
Happy New Year. Good to hear you and see you.
Yeah, same to you. Same to you. Hopefully everyone's having a good break if they manage to get away, and if not, then I'm sure hopefully it's quiet enough around Christmas. A bit more done.
There seems to be plenty of things to be done around this time of year, I have to say. It's pretty amazing. And of course, this is 1 week later than normal because you were off, but I think you've just sort of literally come back on deck now. So to an extent, we're going to make this up as we go along, I think, tonight.
Yeah, that's right. It's I'm hoping you can lead the conversation. I've certainly, I've been doing a lot of interesting reading and looking at, pontificating about some of the longer term trends. But there's been a few interesting sort of news things that have popped up as well over the last couple of weeks. That's sort of well worth getting into. Should I start? We'll let you lead. Where do we start?
I guess what I'm interested in. Before we get into the detail, Damien, is this. There was a lot of stuff written about, thank goodness that 2022 is over. 2023 is a whole new year, right? As though somehow magically everything resets and everything starts from zero again, right? I'm pretty skeptical.
Resets is people's is financial markets have got performance hurdles, and people who get paid performance fees, it magically resets. And so then
well, I think they do. But the externalities whether you look at the energy situation, or whether you look at Ukraine, or whether you look at central banks lifting interest rates, I mean, it's another 2022, isn't it? I mean, I don't know that things have fundamentally changed. In fact, in many ways, I would argue they're perhaps a little worse.
Well, yeah, and I think for me, I think the big picture is, look, now we're going to actually see the effects of the rate rises and what they're actually doing to. So we've already seen some big falls in terms of company earnings. We're starting to see sort of weakness starting to come through in terms of consumer spending, and I guess the question is, post Christmas, does that sort of ramp up to another level? And you do have to play into a certain psychology for, I think even so for. There's certainly a lot in investors, but also in consumers as well. And the idea, I think, for a lot of consumers, look, they know these rate rises are coming, and for a lot of people with fixed rate mortgages, is like, oh my God, what am I going to do when it jumps 3%? And I sort of have a feeling that in December it's like, well, that sounds like next year's problem. And my rate riser is coming, and in the new year I'll start having a look at where I'm spending money and what I'm doing, and then I'll start making some more cutbacks to sort of cater for this rate rise that's coming through.
Well, that's a really good point, because in my surveys I did actually ask a question specifically about that. And quite a few people know that the rate rise is coming, but they'd parked that until January, right? They were not going to let it spoil Christmas. They weren't going to let it spoil the run-up to Christmas. We'll sort it out in 2023. Yep. That's definitely the thematic. And, the RBA is saying about a quarter of households potentially are going to have a rate reset from fixed to a much higher fixed rate over the next few months, this year. And we've got more of those rate rises because there's still a 2 to 3 month lag between the RBA saying rates are going to rise and it actually hitting bank accounts. So essentially, a lot of households are still seeing the rate rises from September and October, not the most recent ones. And the other factor, of course, in all of this is the question of wages growth, because, again, in my surveys, there were quite a few people who were saying, well, hopefully there'll be some better news on wages. But, of course, Phil Lowe is saying, if you get to more than 3%, that's a problem because it's going to be inflationary. So I think that's another factor in the mix too. Yeah,
absolutely. And it's that part where, I think some of the Chaser and the Shovel and people like that have made a number of, quite cutting jokes, I think, in terms of that whole idea that we've had these record profits from companies and but it's consumers and people like that who have to tighten their belts. And, it's companies putting up profits companies putting up prices by 7 or 8% and then raising wages by 3%, improves their margins generally. And so, unless you've got massive other cost rises coming through. And so, I do think there's a certain element of, I do feel sorry for people that's what we've been suggested, is that it's the wage earners who have to take this one. But that seems to be what's happening. Having said that, I do think company earnings themselves have taken so the forecasts have already taken a bit of a tumble.
Yep.
And I think we'll continue to see more of that. That's been really over the last few weeks. We've really seen the numbers come off since I last spoke to you. And I think I've spoken as well about analysts who really sort of have this idea, and companies themselves, is that next year is almost always they think is going to be 10%. That's where almost always the forecasts start. It's a nice round number, and I think it's what people put into their models, and then you start seeing the actual events come out, and then you start going up or down. And so what's happened now is earnings are down to 3% for 2023, and there started to be some hits for the 2024 numbers. And 2022 will still come in as a reasonable year. So that's already done. We've got one more quarter to report for most companies. And so it's really, does 2023 turn into, a 0 year, which, given the pace of the falls so far, would be a pretty good outcome. or does it turn into a -10 or a -20 year? In which case, then all of a sudden you've got a much bigger headwind for companies in terms of the earnings side.
Yeah, absolutely. And it is quite interesting just watching some of those dynamics. I think the earnings question for me is the really big one, because I don't think yet, certainly in the US, the markets are actually have reacted fully to the lower prospects of earnings that are actually going to flow through. And that means valuations are therefore overstated, which means the stock market is still too high.
Yeah. Yeah, and so the stock valuations are mildly expensive at the moment. They're just sort of on the upper end of their past ranges. But yeah, if you knock another 10% off, then that's 10% off earnings. Then all of a sudden they become very expensive. And with falling earnings, do you want to be buying very expensive markets? So that's on one side. I think the other thing on the earnings is sort of keeping an eye on which sectors it's hitting. If you relate back to, say, unemployment stats, what we've really seen in the US is that the tech sector's really been hit in terms of the layoffs. The construction sector's been hit in terms of layoffs, but I think actually net most of the other sectors are possibly even going forward still, I think, in terms of the number of people. And so, is this a typical downturn where those are the sectors that sort of get hit first, and then you start rolling through some of the other sectors, and eventually, it all bottoms out, and the tech sector and the builders are the ones that start hiring people first? Or is this something different? Is this something special, something COVID related that means that all these other sectors actually managed to push through, and we're still worried about pandemic effects? Now, I'm more of the former. I think it is more of a traditional cycle, but just on steroids. I think it's going through much faster than usual. But I guess we're certainly open to the view that maybe it is something completely different, and COVID and all the different effects might mean that something else will actually have an effect that'll sort of drive things in a different direction.
Yeah, and it is, I think, worth just highlighting another factor. If you look at the inflation drivers in the US, the goods inflation is coming off quite fast, which is the base effect from where we had prices last year. But the services inflation, which is very much linked to higher wages, is really strong. And it's interesting that Jerome Powell actually made a specific comment about the wages link and the fact that this is a very important thing to watch, because that will actually drive inflation further and faster into the future. So the inflation story is not dead in the US. And it's interesting, I've read quite a few articles over the Christmas New Year period where analysts were saying, inflation's beat, we're just waiting to see it work through. I still think there's more life in the inflation story yet.
Yeah, well, look, I hope you're wrong. Ideally, what we'd see from my perspective is we'll see that goods inflation continues to go off and actually starts ending up as deflation, sort of pulling down that side of it, the equation. And then on the services side, it reverts back to a more normal sort of range, and then just sort of continues on from there. And what I mean by that is that certainly over the last sort of 10, 15 years, what we've seen is pretty close to zero inflation coming out of goods, and deflation depending upon which ones categories you're measuring in, and then a little bit above average coming out of services. And I think I think there's a bit of payback for on the good side, which I think is going to drag our average below. And so so it's going to be important to keep looking at those two elements as you sort of highlighted them, in that is services going back to sort of 3%, which is where it was sort of pre-pandemic, or is it going to stay at 4 or 5? And you might lose that in the fact that the used cars, for example, has come off now, and it's going to print maybe some -10s, -20%, and really start dragging the numbers back down again. But keeping an eye on that, if services inflation is still staying at 4 or 5%, then we are in for higher inflation. And so separating those two to try and get a guide on the future, I think, is going to be very important over the next few months in terms of, I guess testing that theory about where is inflation going.
Yeah, and it's worth underscoring, isn't it, that the IMF came out over the weekend actually and said they thought that about 1/3 of the global economy would be in recession in this year. Right.
Yes, yeah, and certainly the US bond markets are, suggesting that as well, and the Aussie bond market to a certain extent.
Correct.
Yeah.
And interestingly, the perspective there was before some of the most recent news from China, because of course the China situation is, if you think of what are the moving parts, what are the things that are currently in play? Well, China is in play. The Japanese situation is in play because of what they are doing and what they've been doing with particularly in the bond market and their forward expectations of rates. And the euro area is still, of course, struggling. There's still recession in some parts of the eurozone, others less so. So we're almost wherever you look, you can see.
News there on the energy front, which is sort of
Yeah, well, the energy front's another very important factor there, and we'll perhaps touch on that in a second. Why don't we just talk in a little bit more detail there about Japan, because I think Japan's a really interesting case study.
It is. So here's and I think the key one for me is that it's very hard to know what's going on there, insofar as they do work very closely with the government. We've got a governor who has been long-serving. I think it's 10 years he's been in there, and he's on the way out. And so the question is, if there was a little bit of housekeeping that needed to be done in terms of helping the functioning, is how they pitched it, is that they're not raising rates, but they were letting the 10-year bond rate there vary up to 0.5%, whereas before it was 0.25. Is that it's much better for that to be done by the outgoing guy who's got sort of 10 years worth of history and I guess respect to the markets, rather than the newcomer come in and all of a sudden have to say, hey, I'm reversing what the I'm changing what the last guy was. So that's sort of that's one way of looking at it, is that there was a bit of house cleaning that needed to be done, and that was what's done. And then so now, and Japan really isn't seeing much inflation, and they've been largely right in terms of the idea is that saying, well, if they're not seeing inflation and they're such a huge energy importer, then there's no sense in raising rates anytime soon. The flip side is, and the way markets interpreted it, I think largely was, this is just a start. It's they've finally started capitulating. Yeah, it's only one move, and it doesn't really mean much in the whole scheme of things, but it's one step along the path that they're going to follow, which is what everyone else has followed in terms of coming out, and soon they'll capitulate. So that's how markets have treated it, and that sort of led to bonds selling off, around the globe. I think sort of mid-December, bonds had all sort of come back in and sort of looking like they were really starting to price that 10-year recession in. They were pricing even in more certainty, and yields had started falling. Whereas once that Japanese announcement came out, they've all reversed and sort of headed higher again. So pick your story. I sort of I think I'm more partial to the former story, that it is what they said it is. But I can see why markets are interpreting it the other way. This is one step in the eventual capitulation. But I think that news is going to come out. Japanese inflation hasn't moved yet, hasn't really jumped out of its bounds like we have seen everywhere else, despite being such a huge energy importer. And so it's going to take something quite extraordinary, I think, to get Japanese inflation to really start running, over the next 6 months.
And it's interesting. This is the latest, the 10-year bond, Japanese 10-year bond, right? And you can see here this significant jump up, right? So this is when they basically played that shot just before Christmas, right? And so we've seen that massive run up, which is quite interesting because, of course, then it has an impact potentially on the exchange rate as well. So this is the Japan US dollar exchange rate. So it sort of slid back because it was quite high at 150 previously, right? Now that's somewhat lower. So those are all sort of interesting things. The other, of course, interesting factor here is that Kuruda, of course, is leaving. I think it's the first quarter, isn't it? It's in a few months' time.
Sorry. Oh, yes. Yeah. Well, sorry. Actually, I'm not sure of the exact date, but it's very soon.
Yeah, I think it's sometime in the first quarter. So, in a way, the low interest rate, low inflation story that he's built, that could actually get deflected or changed at the point when he actually exits.
Absolutely. Yeah. New guy comes in and says, yeah. Having said that, though, I don't. I think you would have to. If you're in Japan, it would be quite a different view to, I think, most of the committee members there and the government. I think they work a lot more closely with the government than other central banks as well. And so, yeah, but that is potential. But that would certainly be something out of left field in Japan.
Yeah. So Japan is one to watch, right? Because in a way, it's been the odd one out for some time. And the markets, I think, as you say, are a bit split on whether it's significant or whether it's not significant, whether they're coming late to the party or whether there is actually a different trajectory in play in Japan. And that may inform some of the other inflationary stories in other parts of the world, I suppose.
Well, and the other big inflationary story for the first quarter is going to come from from a close neighbour. Yeah, just across the straits there.
Yes, you mean Mr. Orr.
Yeah, so in China, I guess we're looking very much at the. I guess what I'm saying is, given all the stuff that's going on with the whole, accelerating out of these lockdowns far faster than anyone expected, and disruptions and all these other things that are going on, it's very hard to know really. It's really hard to read any of the stats and work out what's going on. How much of this is COVID? How much of it's underlying trends? Is it going to bounce back? Is it going to fall back? What they and I think a lot of companies, a lot of countries had this real big sort of reopening boom once people come out. Now China's already had a reopening boom because they sort of locked down initially and then got back out again, and so and sort of had rolling lockdowns and been out. So are they going to have another one on top of that, or is it how big is the recovery going to be? And so there's a million and one sort of questions that are popping out of China that's saying, well, I just whatever stats I read and whatever they say, I've just got to take them with this huge disclaimer of I don't know whether this is affected as a short-term or a long-term trend, and so getting the signal out of the noise is going to be very difficult in Chinese stats.
Well, we know that the data is fragmentary at best, right? So on one hand, the official statistics are saying, oh, we've hardly had any deaths. Other reports are saying significant numbers of deaths. The mortuaries seem to be full at the moment, and the availability of some of the critical drugs are also in question. And again, some people are saying that in China, some of the manufacturing stuff is already easing off. Others are saying, well, no, that's more to do with the fact that we've got the Chinese New Year, the Year of the Rabbit, coming up soon, and therefore most people would have got their exports done before the end of the year.
Yes.
So it may not be directly linked to the to the opening up.
Yeah, so the timing's good in terms of a world impact on the world because, as you said, most of the demand was sort of all pre-Christmas, and the demand was already falling quite sharply, and so there is this part about do we need some of that capacity? I think it's the 22nd they shut down is 22nd of January is Chinese New Year this time around. So factories would have been shut for 2 weeks over that period anyway, and so there's probably less manufacturing going on, or there's certainly some scope within the system to have already sort of increased inventories. But it does mean that I guess beforehand we're looking through the Chinese statistics and saying, okay, this is supporting what we're saying is that yes, we're going to see this goods deflation. We're seeing the demand for goods fall off, the rise of demand for services, all that thing going on. Now it's very hard to tell from the Chinese data, exactly what is happening on that front because things have fallen so sharply because of the COVID effects. You just got to throw your hands up and say, well, I just don't know. And so, and then all those other bits about how far, how big is the boom out the other side as well? Is the other.
So a number of people are again suggesting that there will be an economic boost. And in fact, the IMF was talking about that. It's one of the sort of potential upsides. A bit of a dip and then a boost later. So that might help some of the global recessionary conversations. But then, of course, we've also got this decision about testing people coming from China. Some are doing it pretty tough, some less tough. That could have an impact in terms of some of the movements. So it's another big uncertainty factor.
Yeah, and the other one, we have already seen rates come down in terms of the shipping rates have really fallen off cliff over the last couple of months. And one of the things that was sort of always interesting to me on that front is that a considerable amount of shipping is actually done in the bottom of passenger planes. That's where I think it was close to certainly over 30%. I think it might have even been as much as 40%. And a lot of that was planes coming from China to the US or China to Europe. And so even though air traffic actually recovered, last year, air traffic from China hadn't recovered.
Yep.
And so the fact that most of these prices have fallen so as far as they have, even given that, now that we're actually seeing opening up of China in terms of and the air travel starting again, there's actually potential that we could see even further falls in prices for because we've got all this extra capacity in terms of transport costs.
Yeah, well, that's a good point. And interestingly, there was a lot of deep discounting going off around November, December around the world, right? So some of the big sport shoe wear makers were deeply discounting just to shift inventory because they've got a whole load of inventory backing up. And even Tesla's been discounting some of their EV vehicles, right?
Yeah, well, and this is the argument that a lot of them sort of got into, is that you had a boom in demand, and so you went from selling, well, let's go pre-pandemic, you're selling 100 units, and then pandemic hits and you're selling 50 and you cancel everything, and then all of a sudden you're out of the pandemic and everyone's ordering stuff, and now you're selling 120 units. And so is 120 the new normal, or are you going to go back to the 100? And how long is the 120 going to last for? And so most of them were sort of running it at the 120, and then now we've fallen back to 100 or a little bit above 100. So maybe it's fine relative to where we used to be, but it's still a big drop. And that's that. That's the part that is going to affect earnings, and that's what we're looking at in terms of the company side. Is that's where the most danger is in terms of that, and it's working out which of the companies out there increase their prices because they could. Everyone else is raising prices, and a good example of this is your telcos. Telcos have seen falling prices for years, and then all of a sudden there's this source of inflation, where it's basically, well, everyone else is putting up their price, I guess I can put up my prices as well. It's not like but it's not like their costs are any blown out or anything. And so the question now is, do you have enough pricing power to hold on to it, or is all your competitors going to be out there saying, I used to be able to make a car for whatever $20,000 and sell it for 30, and so and now I've been able to sell it for 40 because nobody's able to get it. Does price push it back down? Does competition push it back down to $30, or do they all get to hold on to this higher price? Now, thinking the cars, it'll get pushed down. There's lots of competition. In some other sectors where you sort of have more oligopolies and stuff like that, and not a lot of pricing pressure, then maybe they'll be able to hold on to some of these rises.
Yeah, absolutely. And that, of course, is the big question. And it seems to me that not all corporations are going to be in the same position with regard to their ability to be able to make price rises stick. It depends a little bit on how unique their products and services are, whether they are actually competing with other players who actually have a different cost base, all of those sorts of things. So I don't think there's a universal answer to that question, which is one of the hypotheses that we always have. You have to go and look at individual entities. You can't make generic calls about the whole market, right? Because different organisations are in different places. They've got different cost structures. They've got different approaches to the production cycles that they're part of, and therefore their ability to be able to price and hold higher prices will be quite different.
And I think there's that, as you said, everyone's different, but even within industries, you'll see the ones, and we talk about quality companies, and what I mean by quality companies is companies that have higher margins, companies that have more stable earnings, and things like that. And they do tend to perform over the sort of cycle. They tend to perform better, but not at all points of the cycle. And so quality companies actually had a pretty bad 2022. We saw mostly, the story for 2022 was value stocks, and value stocks are mainly banks and resources and energy stocks, and so a lot of sort of the more commodity end of the industrial market. So people who are selling things where if they put the prices up, they'll stop selling, and because their competitors will take away from them. And so those companies actually managed to get a lot of price rises through because of all the inflation. And so they were the story of 2022. We think quality companies is where you should be here. So rather than being in value, now is the time to be in quality for 2023. And that's where you're going to see the reversal of that trend, and you're going to see the companies that do have genuine pricing power hold on to it.
Yeah, that's very interesting. When you say quality, what do you mean by defining quality?
Quality, and I'll tell you what MSCI means, because they're sort of the I guess the arbiter of it in the official sense is quality companies, and what they mean is companies with high return on equity. They mean companies with a higher margins, and companies with a lower amount of debt. Now, I think there's a bit more to it than that. You sort of then you then start getting into the higher return on equity is that a right measure? And I could spend too much time that you guys wouldn't be interested, but effectively, the big picture story is. Accounting standards have changed over the last 20 years. And so equity gets written down, but never gets written back up again. And that didn't used to happen. Yep. And so what that means is return on equity looks much higher than it really is. And so you get companies like IBM was a great example. As they were moving from being a manufacturer to a services company, their return on equity hit 75%. And it's like, really? You put $1 into that company and you earn 75 cents the next year? Absolutely not. There was no way they were earning 75%, but the way the accounting standards had it was that was what's happening. And so, so I do think there's some you do need to look a bit more deeply than just that. And so looking at which are the companies that have the highest margins in their industry, which are the companies that have low volatility in terms of the earnings that they make, which are the companies that there's a whole bunch of different measures we use. Looking at earnings growth, is it and how volatile it is, how close are analyst forecasts to traditionally to what the company actually ends up reporting. Looking at some upside downside stuff about and especially the whole COVID bit was hard, because you sort of got to look and go, well, here's companies that managed to hold up really well throughout COVID because they were in a particular. They happen to be a sector that just wasn't affected. And here's other ones that actually, there are high quality companies, but they're just in a sector that got smashed by COVID. And so how much do I need to wait for that versus for more normal times? So,
Yeah, absolutely. And it's really important, I think, for people to understand that not all companies are the same. Even companies in the same sector can be quite different. I look at the financial services sector in some detail. And while superficially they might look the same, when you actually peel it down, you can see some quite significant differences. And it's not just, I would take an Australian example, Macquarie versus CBA, two very different entities, although they're both in the financial services sector. But even if you look at the big four in Australia, while superficially they look the same, in fact, structurally and from a revenue perspective, they are quite different. So it is actually quite important to do enough work to understand how different they are.
Well, and it depends on who's defining your sectors as well. I mean, if you use there's a global industry classification system called GICS, and one of the things I'll sort of one of the examples I use is the oil services sector, which sounds like it should be all made up of similar type of companies. They're all servicing oil companies. But some of them are literally, the owners of these rigs, and then they just lease them out. So they spent, hundreds of millions of dollars building these things and then leasing it out to companies. And so when you have downturns, they get hit. They've got all these things unleased. Other ones are services where they just hire people and hire engineers and rent them out. and so they're effectively labour hire companies. Extremely different business. One of them's almost completely variable cost, and the other one's almost completely fixed cost. And then you have people flying helicopters out to oil rigs and all these other things. It's just one sector, but the actual companies in it are very, very different in terms of how they make the money, and then the types of ratios you expect, because the types of margins you get on a labour hire company is very different to the types of margins you get on leasing out ships to other people, and your amount of capital you need and all these other things are all very different. So even looking at financial ratios, you just need to acknowledge that, look, these companies just aren't the same. So I can't use some ratios you can compare with, but there's a lot of ratios you just can't compare.
No, absolutely. And, again, you have to go granular, you have to really get into it. Now, I guess there's another interesting angle here, because we've been talking about some of the companies and what have you, but the consumer's a really interesting thing to look at, right? Because we know that consumer confidence actually in most Western economies is pretty low at the moment. And we know that many economies are very reliant on consumers continuing to buy stuff to be able to support the economy. Something like 70% in the US, it's more than half in Australia. So what's your read on the consumer, and how does that play into this question of future earnings of companies, and where it's going to play through?
Yeah, and that's that uncertainty part we're talking about. Look, I think the next few months is going to be the most telling on the consumer. I think the consumer will be weak, largely just because it's of the amount of interest rate rises we've had. If you're looking at if you just purely took the amount of household debt times by the change in interest rate over the last year, you're talking about a 4% change in Australia. Now, that's not, there's a lot of people on fixed mortgages who will be rolling off, and there's all these other things going on, and not all household debt was priced off of those rates. But it's about, as I said, 4% of GDP. It's a massive number, and it's about double what we've ever seen before in the past. So I can't see any way that the consumer doesn't get hit particularly hard by that, and we're seeing that in a lot of the house price falls, and I think we'll continue to see that sort of flow through. But I do acknowledge there's uncertainty. We haven't seen as much weakness as I would have expected so far, and so and this story we're saying about the we'll worry about it after Christmas. If that's true, then yes, we will see the weakness. But maybe that won't be true. Maybe there's something else that'll crop up, and consumer spending will keep going for another 6 months or longer. And so. I think there's enough uncertainty around at the moment. You whatever view you have, you need to at least acknowledge that you might be wrong, and set your path to the way you think it's going, but be prepared to change paths if the data keeps coming out showing something different.
Of course, the RBA is arguing, well, employment is very high. It's a record level. Unemployment is a record low. Mirrors, by the way, what's happening in the US as well. And so that means that we've got a significant proportion of the population who are still in work and can continue to pay those bills and continue to buy, and et cetera, et cetera. So therefore, because of this such low level of unemployment, the risks to the economy are much lower than normal.
Yeah, I think there's a problem with that argument, in that employment is usually the one of the last things to go. So when companies start running into some cash flow problems, or they start having some issues, the first thing you cut back on is the easy stuff. Okay, I'm not going to spend as much on advertising, or I'm not going to, a bit of discretionary. We won't take people out to as many company lunches, and whatever it is. There's a bit of that stuff that all happens, which is nice and easy because it doesn't really hurt that much. And then the next phase is the more sort of permanent ones, where it's like, okay, we wanted to hire a bunch of contractors, get something done faster, and so we won't do that. Or this project's going to get shifted off, and you start seeing the effects of that. And it's only, once you've sort of exhausted a whole bunch of other things, that then you start saying, okay, well, now I need to start cutting into my staff. And so, and that can take months to run. And I fully expect we're already going through that process. And so, once you actually start seeing the unemployment rises, and given the lags we've spoken about in interest rates, it's all far too late. Like it is absolutely looking at the rear vision mirror to try and work out where you're going. And so it is, to me, it's more about looking at some of the surveys about what companies are doing, their hiring policies and things like that. And again, their surveys, you can't. It's the softest data that you can't really point to and and sort of nail down and be sure about it, but it's more timely. And so, so I think that's probably where, I'd be leaning on, is saying, well, I don't want to look at those, I don't want to use the unemployment rate itself to drive my decisions. I want to look at all these other employment factors and try and work out what they're telling me, and they are pretty weak.
Yeah, absolutely they are. And of course, tech has been laying off quite big in the US, and in fact, I was talking to somebody the other day who's involved in Australia with second-hand furniture. And he was telling me that he's had a very large load of these high-tech chairs that, the IT sector goes for, the very expensive ones. Well, he's had shed loads of them because, in fact, even in Australia, some of the IT jobs are actually disappearing. So that might be a better leading indicator than the official employment numbers. Yeah,
that's right. It's the additional those extra stats, and that's the type of ones where we're saying, there's, you don't take one of those on its own and go, this is it. But there's if you can get, quite often you'll see a dozen or more of these types of things all start to crop up at the same time, which is just that indicator that things have started to really slow down in that point. And so I think that's where looking at as many different indicators as you can, and then trying to work out which ones are telling me. It's not a matter of ignoring the ones you don't agree with. That's often just as bad or a fault. But it's trying to work out where that sort of sits in the scheme of things.
Yeah, absolutely. And let me just take this from Bed. Bed, as you said, the audio clipping pretty hard. I'm not sure whether other people would agree, but do tell us if you think the audio is not up to scratch. But I've checked it, and it looks to me as though it's running pretty well at the moment. So anyway, thanks for the feedback. But folks, tell me if you think the audio is right.
I was just prioritising my computer just in case on the Wi-Fi, in case any of my kids are sucking the juice.
No. I think you're fine. People maybe were suggesting that the audio was a bit loud, but it's peaking as normal on my end. Anyway, now let's talk for a little bit about property prices, right? Because
before we get into that, should we? So we've did the US. We've spoken about Japan. We've spoken about China. Europe, just quickly as well.
Yeah. Okay. No, that's good.
Let's get back to. Yeah. Then we'll circle back to Australia. So the other factor on. So we've got the US where goods prices falling, services prices, we want to try and work out how far they're falling. We've got Japan, low inflation, but there's been a few little signs that inflation's, a little bit higher, and the governor making changes. We've got China rushing, coming out of lockdown, but sort of in a way going into lockdown as well because of all the coming out of official lockdown, but going into unofficial lockdowns, stuff going on all over the place. Maybe there's going to be more inflation coming out of that because of supply chains. Maybe not. Timing's good because of that. So we've got that going on. Then the other big place of inflation was energy. And Europe, we spoke before last time about saying the danger was that Europe had a cold winter. Now, I think they had a record. There's a whole bunch of countries in the last couple of days that have had record temperatures in terms of record high temperatures. Yep. They're talking about temperatures in winter that they'd be happy to have in summer. And so what that's meant is that gas prices have fallen, and that really, so that probably means we're going to be fine for this this year, for this winter. So we've got a few months to go, obviously, but the stores are still pretty full, and so it probably means you're going to get through this winter, all right. What that means as well is...
Just let me interrupt there 1 second. This is a really interesting chart. This is the Dutch natural gas futures, right? It happens to be based in the US, but it's very interesting, right? We had a peak in August last year at 338, right? It's currently down at 76. That is a huge drop, isn't it? I mean, it really just underscores...
It is a huge drop. But it's also 3 times higher than it used to be.
I was going to say exactly that. But it's all relative, right? Because look where it used to be. It used to be down here at 10, right? It's now 76. So we're not out of the woods, but it's a very different perspective from where we were quite quite recently.
Yeah, that's right. And so and what that means from the gas front is, okay, so electricity prices is probably not going to be as big of a source of inflation. Similar things happen in Australia. So magically, we just spoke about having these price caps and all that type of stuff like that, and magically the prices all fell. So it does look like that's a big plus again for inflation. Will we have the same problem again next year? Maybe, if it's a particularly cold winter, but it's going to be far better than it would have been if it had been a cold winter this time, because it's another 12 months to get the transition, whether that's transition to building more gas imports from the US and other places, whether it's more renewable energy, all these other things that they're trying to do, changing source of it, keeping, restarting power plants and all that type of stuff. I do think there's it's been a big positive in terms of the inflation story, what we're seeing out of Europe, because that inflation would end up somewhere else as well. Like it'll be much worse in Europe, but you'll see the effects elsewhere, and also the demand hit. So people are spending $5,000 to heat their home for 3 months they're spending $3,000 rather than $5,000. That extra $2,000 they've saved, gets to go out and buy more coffees or go to see movies or do all these other things that they might have cut out on if those energy prices stayed so high. And so so that's sort of was potentially a real danger and a big plus.
It's quite interesting because some of the people at the ECB started to say things like, well, recession may not be quite as bad as we thought. We also accept that there might be a need for wage rises to be a little higher than previously, and that isn't necessarily in itself inflationary, which is quite interesting. So there's a little bit of shifting of ground going on in the Eurozone, despite the fact that they're still talking about putting rates up higher.
I know. It's just and the thing is, it just seems strange to say, well, yeah, we've got this energy prices going on and this inflation that's coming out, and so therefore we need to crash the economy to bring it back, to bring down energy prices. And it is, for a country like Australia, that's ridiculous because we're so small, we're not going to affect global. For Europe, it does; they will affect, global, and the US will affect. I sort of feel as if there's not that far removed from Japan, and they've struggled so much with inflation, just being able to get inflation going ever since the financial crisis. Unemployment's low in some places, so Germany, it's relatively low, and Netherlands, but the southern European countries are still relatively high in terms of the unemployment rates. It's
Sorry, I pushed the wrong button then.
Yeah.
John Adams popped up. I don't know. Where did he come from? Sorry about that.
That's all right.
I meant to push that button. It's very interesting. One of the factors here is, of course, the Eurozone is actually diverse, right? Yeah. I mean, if you look at Italy and Greece compared with Germany and France, I mean, they are very, very different economies with different dynamics, different bond rates, different employment levels, well, a lot of things. And of course, quite a lot of the protections that have actually been built in to the euro is trying to protect those that are actually sort of, not Germany and France, but the others. It's a really complicated mix.
Well, and look, I could spend an hour, I spend a whole podcast talking about this, but there's this, the concept of some countries are net exporters and other countries are net importers. And then the question is, whose fault is that? And so let's take the China and US. The story is China's very good at making stuff cheaply, and the US keeps spending beyond their means to buy all this Chinese stuff, and so China has to lend the US money so that they can buy all this stuff. And so isn't the US terrible with it? That's one way of putting it. The other way that many economists actually look at this problem is saying, well, actually, no, the problem is that China's keeping its currency too low. It's putting all its dollars. So rather than the dollars flowing back from the US into China, and therefore the Chinese currency rises, and these cheap Chinese goods turn into not so cheap, and so the US doesn't buy as much of it, and so then the whole trade equation balances out. But China hasn't been doing that; they've been pouring their money into it, and so that's one way. You've got a similar story in Europe, where but what's happened here is Germany put on a whole bunch of wage constraints sort of coming out of the financial crisis. And what that's meant is that Germany can still produce a lot of stuff more cheaply than other countries. And so they're sort of, the whole part with Spain with these big deficits, and Germany's this great country that sends all these exports down to Spain is actually sort of, in a way, is a bit of an argument that's saying, well, if Germany let its wages rise to more reasonable levels, then that whole equation would even back out again. And so, is it a question of the country who's taking the cheap goods and hasn't got the artificially low wages, whether it's by currency manipulation or by wage accords, whose fault is it that these imbalances have happened? And so, I think as you can guess from the way I've explained it, I am certainly partial to this idea that, when you've got these big deficits and big imbalances, and you've got one country that's keeping its wages artificially low, it's on that country that's creating the imbalances. But the argument always goes the other way. It's like, oh, you guys are spending beyond your means. You shouldn't keep taking the money that we give you, to buy our products. And so, yeah, I think there's I think Europe is very much locked into that type of relationship at the moment, and because they're on the euro, there's no easy solution to it.
No, because at least they're locked in, aren't they? Yeah.
At least in the US and China, there is a currency thing there, and then also if you look at like a country like the US, it's not that mobile really, but at least you do have some people moving from one place to another. So you can say if there's lots of jobs in Texas because they're doing lots of drilling and whatever it is, and there's not many jobs in New York, then people will move from one to the other. Yep. That is theoretically what should happen in Europe. Is that lots of jobs in Germany and not many jobs in Spain, or Greece. But I think the argument is that it's very hard to make people in Greece move villages from one village in Greece to another village, let alone move right across the continent to a country that doesn't speak the same language. You don't have that same mobility, and so therefore those labour problems can't even be resolved. In that one country has low wages and the other one doesn't. Low unemployment and the other one doesn't.
Absolutely. No, very interesting. And you've just touched on something which I wanted to get to. We'll get to it now, and that is the exchange rate, right? Because what's fascinating, of course, is if you look at the DXY, which is effectively the US dollar index against the basket, we were up at 114. We're now down to 104. That's a significant shift back down. And if you go back to 2021, we were at 90. So we've seen this huge volatile movement in the US dollar relative to the other currencies around the world. And of course, that's having a significant impact on both the impact in the US, but also on the international exchanges as well.
Yeah, and in a way, I think about that, especially that sort of exponential rise we saw at the end of the 2022 as being that's effectively the world economy's way of trying to help Europe, because you're in this. I think the euro is sort of 60% or something like that of this, maybe 60%. No, 60%. I think of the DXY is the euro, and so what it's effectively doing is going, okay, let's make European goods cheaper. They've got all these massive energy shocks coming on and this big recession, sharing on this big barrel of this big recession because of all these energy problems. So let's make their goods cheaper so that the US will actually want to buy more of those goods. And the US has got this running hot inflation problem. Let's actually bring import some goods from that, and that'll mean there'll be a few less American companies selling goods. So that'll take a bit of heat out of the US economy and sort of transfer a little bit back to Europe. And so some of that fall back is the the price. The price falls in because as you can see that it's not completely mirrored, obviously, but it's quite close to that energy cost chart that you put up a minute ago.
Yeah, funny
and
that.
So yeah, and so some of that's there, and the other parts, then that comes back to how it affects. But do keep in mind that these the levels to me in terms of currency, there's a very short term effect, but then there's a very, very long term effect that sort of depends upon long levels, and Australia is a good example of that with our manufacturing, in that low Aussie dollar. All these manufacturers come in and making cars in Australia, and then the Aussie dollar goes flying up to $1 US. They all shut down and go away. Well, the Aussie dollar could fall back to 60 cents, and it has, at times fallen back to even lower than that in the pandemic. All these car places didn't open up again like that. It takes a long, long time of having that low currency before you will see genuine new industries pop up. But what you will see in the short term is you will see the hiring processes go through. So, Australia wants to, you're hiring a new lawyer or a new accountant in your Asia Pacific region. Okay, do I hire them in Sydney? Do I hire them in Singapore? Do I hire them in Tokyo? And a lot of companies will go, well, okay, Australia's cheapest at the moment, let's hire it there. So that'll happen, gradually. Well, that's a sort of faster moving, and then the longer one is the manufacturing and actually genuinely setting up new operations, stuff like that. That takes a lot longer to kick in.
Yeah, absolutely. And we'll just show that this is the Aussie dollar, right? So to the US, sitting at 67 at the moment, but we've been around up to the 80s,
absolutely.
Down to the 62.
Well, I go back a year and we were in the high 50s.
Yeah, exactly.
So, yeah.
So all over the place, really. But that, of course, has a significant impact. And I think it's a really important point you make about the lag effect. So, if you are going to make investment decisions, it's going to take time for that to work through, right? And you're going to make decisions based on the relative strength or otherwise of currencies and locations. But it's not a sort of a 3-month thing. It's a multi-year thing, isn't it?
Yeah, absolutely.
Yeah.
Absolutely. And actually, the one last thing, the other thing I forgot to touch on as well before we get off it's actually back to China, was the comments that they made in terms of the property market there. So we've spoken a number of times about the property market and how much building they've been doing relative to the population size. Now, for the last couple of years, every time they speak about the property market, they've been saying property is for living, not for investment, not for speculation. Sorry, property is for living in, not for speculation. They dropped that in the most recent releases that they've come out to say. So there is a question, which is why we're seeing the iron ore price rally from $80 back up to, or below 80, back up to sort of into the hundreds.
Yep.
And we actually took off. We were quite underweight a lot of that iron ore sector, and we put it all back on and just went to market weight, because there is a question about, are they going to try and reignite this property boom? There's a lot of, the iron ore price is saying yes. And then the next, and even if the answer is yes to that, is will they be able to? Because in the end, this is, we're not talking about a boom in terms of prices. We're talking about a boom in terms of construction. And we've got a lot of these property construction companies over there that almost went bust. And we're not paying their foreign debts and all these other things. And they had the 3 red lines put on. It looks like they're starting to take those off now. And there's been some prominent sort of party-aligned think tanks that have spoken about saying maybe the 3 red lines was a mistake. So if they do, will that reverse? And can they make it reverse? Because they effectively need these real estate companies that almost went bust. They're going to turn around to them and say, okay, I know you almost went bust, and we almost, but now we want you to borrow more money and go build more stuff. Will they do it? I don't think that'll be as easy as they think it will. I think these will be very reticent to get out and borrow more money and build as much. But maybe it'll come at the point of a gun, and it'll be no, Martin, I'm not asking you to whether you want to do this. I'm telling you, borrow this money and go build more stuff.
And certainly the powers that be have recently said we are going to do more investment to help the economy in Japan, right? So they are worried about the growth. They're talking 3 to 4. I think the IMF was thinking closer to 3. I think maybe now it's up to 4, which is a lot lower than previously. So they've got a growth problem. And
And the other thing to remember with China is there's two other things with China statistics. People talk about how much is faked and how much is real and all that type of stuff. One of the big things you need to remember when you're looking at GDP numbers is there's no write downs in China. So if you build something in Australia that doesn't work out, you build a toll road and you spend $1 billion building a toll road and nobody drives on it, you got to write it down to $200 million or whatever you think you can actually sell it for. In China, that never happens. That's not a feature of their GDP accounting, and so it means that the growth we've seen, because that doesn't reflect it, the growth is naturally higher, and so if they are wasting lots of money on projects that aren't needed, building toll roads and bridges and airports and all these things that they don't need because they haven't got the capacity for it, you don't see that in the GDP statistics, and that's why you sort of see a higher GDP number than elsewhere. Yeah, and then the other thing is it's a target, so for local government officials, so which you don't see in Western countries, and so but what you do see in Western countries is you see things like that for profits and sales, and like we don't even. Like the stock take sale, the annual stock take sale. Effectively, all that's saying is, hey, we've got a lot of money tied up in our goods. We want to make our books look good before the end of the year. So we're trying to sell stuff so we can say, oh, no, look, we're not carrying $100 million worth of goods that we don't need. We're only carrying $50 million worth of it. And look at this cash we're getting. Yep. So you're basically saying to people, you're loudly advertising, I want to cook my books to make it look like I've got more cash than I really ordinarily do in part of an ordinary cycle, and that's your stock take sale. So we know that happens in Western countries. The exact same thing's happening in China, except at a GDP level, because that's what they're being measured by. And so because that's what they're being measured by, that's what they're the books you need to cook. How do I cook my books to make sure that it looks like I'm doing more GDP than what I really am? Well, I'll do what it needs. I'll do what I need to do, and I'll come up with fancy accounting methods and different ways of doing it. But yeah, so that's sort of the two main differences I think you should keep in mind whenever you're looking at Chinese growth statistics.
Absolutely. And I will just show you, this is the iron ore fines from Singapore, right? And so you can see there that back in 2021, we hit a peak of 220. It dropped right back to the sort of the 90, then it's come up to 160, then it's down to 77, and now it's up to 117, right? So a little bit all over the place again.
Yeah. So my long-term stuff on this is companies are prepared to produce at less than $50. They'll make money at $50.
Yep.
The big guys, not the little ones, the big ones. And that's where I sort of put my longer term. Is its cost of production plus a little bit, and they'll squeeze out the small guys eventually. And so, but the number one thing for iron ore is what is China doing? What is China's construction doing? Because if they can get that going again, then maybe the iron ore price goes back to $200. That's completely feasible. If they want to run a massive housing boom to try and sort of smooth things over there, when I'm saying housing boom, house construction boom, but it doesn't make sense. That's what they want to do, but they might from a investment perspective, but maybe from a social harmony perspective, that's where they end up. I mean, they've done it a few other times. They just gave up and went, well, we know this works. We've done it before, and we know if we just throw lots and lots of dollars at this, that houses will get built, which give people jobs, which will make people feel wealthier, and on you go.
And it's just worth reflecting, if the iron ore price went up towards the 200 again, that would be a huge bonus to the Australian economy, wouldn't it? Because it's a massive flow back in. Whereas when the rates are lower, whilst the manufacturers and miners can still make money, it's nothing like as big a bonus to the Australian economy.
And the Australian government as well. Yeah. Like we get good royalties from iron ore. We get very good royalties from coal, coal prices have been really high for the last 6 or 12 months. We won't get on the gas, but we should be getting bucket loads from the gas, but we don't, because we don't price it. So yeah.
We might talk about the gas thing in a second. There was a question that came in, and Jason, thank you very much for the super chat, which was along the lines of, what do you think if investors sell up and exit the property due to low ROI, coupled with more returns from term deposits, it might see prices going down due to the lack of people buying, would this lead to increases in rent in a falling market? So this is a way of getting now into the Australian property market discussion, which is a multifaceted, multi-moving point. And Jason, thank you very much for the super chat to sort of get us going on this one. And just to be clear on the way in, the latest data from CoreLogic showed the most significant drop in prices since 2008 over the last 12 months. And Melbourne now getting to the point where most of the COVID run-up is now reversed. And they're arguing that maybe other places too. So we're in an interesting point of gestation with regard to property prices. And as Jason says, if you are actually a property investor with higher interest rates, whilst your gross investment return might be a bit higher, the net investment returns getting shot. And I'm seeing more and more people with investment properties just not being able to make it work. So how are you reading all of this, and how does that sort of play into some of your thinking?
Yeah, look, on the property side, I'll bring up my my list of factors, but I guess the short answer is I think there's only one thing that matters right now, and that's the interest rate. Is that every other factor? Yeah, it's important, and it'll affect things over the longer term, but in the short term, the only thing that matters is that we've seen a record speed of interest rate rises, and so therefore, property prices are down and copying it. Now, on the sorry, let me just pull out what I was looking for was, so these are my factors that I think goes into property. Actually, I might even let's see if I can share screens on that for you. Sorry.
It's in there somewhere.
Yes. Just pulling up the right screen first before hopefully they've got the right one. Yes, that's the one. So, I look at these demand factors. And so I've got here credit availability. And that's the one that got us pre-COVID. We had that big bust around the Royal Commission. So that's pretty good. It's a little bit slower than before with some changes, but it's still not restrictive. The price of credit is the key one. Employment is, there is some improvement in wage growth, but we're from record lows in terms of wage growth, and so I think employment is a net neutral and quite possibly heading negative. Population growth. Now, this is the one which is affecting, I think will affect that whole rental side as well. I've got a question mark there in terms of the reopening of borders and the speed and take up. And I guess the reason why I've got a question mark is because I do think there's a bit of a flood coming in of pent up demand. I think it's probably going to stay high, but I'm not positive on that. I think in terms of foreign buyers, Chinese buyers are still not back. So, that's a net negative, but then, the rest of them are positives in terms of tax incentives are still there. Money laundering is still rife in Australian property, and that if they ever put those money laundering laws on, that'll be a negative. But I haven't seen any concrete signs of it. I'm not sure if you've caught anything, Martin.
No. I've asked a few pollies and they're not interested.
No, that's what I would have thought.
I suspect they're being lobbied by the property sector, so don't touch it.
Yeah, and look, they've ticked the box now for we've put in the anti-corruption committee, and so therefore we've ticked that box. We don't need to do it anymore. So so that'll probably only change once we get international pressure. We're starting to get a bit of international pressure on it because we're one of the few countries that hasn't done it. But anyway, it's not coming soon. The supply factors are the weird ones for me. So you still got the building process, still apartments still coming out from before. But on the flip side, then you got all these developers collapsing, and you still got all the buildings sort of from the push that we had. What was it called? It was the extra money they gave away. Job builder? No,
home builder.
It was home builder. That's the one. But then the other one is this whole structural change about people want houses rather than units. People want to be in bigger houses. They want more room, fewer flatmates because more people working from home. All that type of stuff is going on at the same time. So there's, I guess in the short term, I think that as I said, that interest rate's the only thing that matters. I think over the longer term, we are probably going to see some over the longer term, I think it's an economic issue at this point. I think people would like to live in bigger houses and all that type of stuff, but with interest rates going the way they're going, it doesn't take much in terms of people going, well, I'll have an extra flatmate. Kids spend another year or two before they move out. Just a few of those small changes around the edges, and everyone sort of squeezes up, and that can easily get rid of the problems that we're having. So I would say we're still in for rental growth for a little while. If the recession gets bad, then that rental growth will disappear, because I do think there's capacity around. I think it's, what did we talk about before? 10%, 11% of houses are unoccupied.
Well over 1 million. Yep.
Yeah, there'll be people who are, eventually, okay, I'll sell that holiday house, or maybe I don't need an apartment in the city and a house. Maybe I'll just have one, or I'll rent the apartment out, or whatever it is. And so, the argument I see about from when you see the lobby groups complaining and saying, if this happens or whatever happens, then investors are going to flee the market. People have nowhere to live. Is a terrible argument, because it's like
vested interest argument, right?
Well, yeah, it's basically saying, I'm going to sell my house, and it's going to remain empty. Yep. Like, because if you're selling it to somebody who's going to live in it, well, that just means there's one fewer renter that's come out of the place. Yeah, the real danger comes when you've got the incentives for people to have more than one property, and leave these things empty. And that's usually an economic argument. And I think if we're going to a recession, that argument will go away, and everyone will squeeze up. And yeah.
So there's a couple of observations there. The first is, of course, the distribution of property investors is quite interesting. There are quite a few people with just one or two properties, but there's a lot of people with a larger portfolio of properties, and in fact a tail with 10, 20, 30 properties, right? So talking about the property investor in generic terms doesn't make a lot of sense, right? Because a lot of people are actually highly leveraged across multiple properties, and some of those are quite exposed at the top end with those multiple properties. Down at the I've got one property or two properties, that's when it's quite interesting at the moment, because I'm seeing a lot in my data. A lot of those people are actually quite struggling now to be able to make any sort of return. And as Jason said, when you can get 4.5 to 4.9% on a term deposit, which is relatively risk-free, and you can tie your money up for 5 years if you want, well, there aren't many properties that you are getting a net investment return, anything like that. And particularly if you don't think there's going to be any capital appreciation over the next 2 to 3 years, then the investment thesis for property investment actually doesn't work for those people.
No. Well, I mean, I think that they talk about the different ways of going through, and if you when you're borrowing money and losing on the deal, then and expecting to make it all back in capital returns, and that's getting close to the Ponzi stage of the whole the whole factor. I do think houses have its problem in that, or have other things in that people have, as you said, people do want to live in them, and some people want to have more than one property, or lots of people want to have more than one property. And we've obviously opened the gates to lots more people coming in. So I think there's all those factors sort of will feed into that. But I guess the argument, I guess what I'm getting back to is the argument he was saying, will people flee because of the low return on investment? I can see that. I guess what I'm saying is that I think whatever happens with investors, though, will be overwhelmed by the rise in interest rates. And that investor argument about that versus rental growth and all those other things won't come out for another couple of years, because the rise in interest rates over the last 2 years just swamps any other factor.
Yep. Well, in my modelling, it is availability of credit, which is a function of interest rates, the interest rate buffer, and the borrowing power that people have is by far the biggest set of factors.
Yeah, but I think about credit availability as being, are banks lending to anyone with a pulse, or are they actually paying a bit of attention to it?
Mostly just with a pulse at the moment.
Yeah. Well, I guess what I'm hearing, and this is the interesting to hear yours, is that it's about saying if you're an all right credit, so or a good credit, then absolutely no problems. You can get loans at cheap rates, and they'll throw whatever they can at them. If you're on the edge, though, they don't want to hear from you. So, which is different to where it was, a year or two ago, where it was like, okay, you're on the edge of being able to do this. Okay, how can we restructure things so that we can get this loan over the line? Whereas at the moment, it's like, well, why don't you go somewhere else? Yeah.
Well, there's a bit of that, but I'd also say that there are some interesting examples where refinancing of existing loans from one bank to another has gone without a new credit assessment. So
Really?
The bank is taking the previous credit assessment and just going with it.
Right.
That's because the particular banks involved there were lending below trend and needed to grow their relative volume. So they are not being very picky at the moment.
Any banks you're allowed to name?
I won't mention by name, but
Okay.
there are a couple that are definitely doing that at the moment.
Yeah.
And others are actually shading some of the, for example, investment properties. You're meant to take down the gross return from the rental stream by 10 or 20%, right? And another bank has moved it from 20% just a haircut of 10% now to give more flexibility to be able to lend more.
Right.
Now,
Yeah.
it surprises me that at this time in the cycle, when interest rates are rising with everything else, that banks are still effectively
Trying to throw credit as much as
pushing
they can.
as much through as they can. And interesting, the data that came out today from APRA showed that actually credit growth was quite strong amongst the majors, particularly CBA, Macquarie, and ANZ.
Yes.
So it's not as tight out there, from what I'm seeing, as some people are claiming it is at the moment.
Yeah, and that's and I guess where I was getting to in that was that's what sort of drives that that credit availability part is what drives the bigger crashes come when you've had things have been far too loose. Now I don't think it's been terribly loose. It's not like a 1991 or it's not like a 2006 in the US type lending conditions, but it has been. We've certainly been a lot looser than we were when there was a Royal Commission hanging over their heads and they thought things might change.
Well, it's just worth remembering, until recently, APRA had 2.5% buffer, right? Interest rates have now moved up more than 2.5%, right? 3%, in fact. So we've maxed out on those buffers that were actually there for a lot of loans that were written for the prior 18 months or 2 years.
Yes.
That's a problem.
Yes. Yep. So I fully expect. Look, and that's the part I must admit I would have expected to see more damage already, and so we'll see where we go for that. But I do think that as I said, 4% of GDP is a big change, and so in terms of the amount that people are spending on interest, and so it's that'll flow into every other sector.
Absolutely, and I will just flash this up. This is what the latest this is the CoreLogic data that Chris Joy put out at the end of December, which basically showed that we've got a significant drop, and in fact, associating it all with when interest rates started to rise. So again, it's another example of clearly there's a very strong connection between what happens to interest rates and credit availability and what happens to the story when it comes to the price trajectory. So prices are on the way down, particularly in Sydney and Melbourne, but elsewhere too. So one to watch, I think, in terms of the way that it goes. So I guess as we come to the last 10 minutes or so of the show, there were two things I wanted to touch on. Early on, Cookie Boy asked about the energy thing and whether that's going to impact what the RBA does. My own view is probably not, but I don't know whether you've got any thoughts on that. And then I also wanted to get your take on all the things we've been talking about. How does that shape your investment thesis for investing through 2023? And, what are the things that you're looking for and what are the things that you're trying to avoid at the moment?
Yep. Okay. So sorry, the first question was...
energy.
Energy, yes, that's right, sorry.
Energy. So we've got this sort of compromise, quote unquote, right, which may or may not have an impact on energy prices, but it's probably going to be still quite inflationary.
Yep.
Is that going to have a big impact on what the RBA might or might not do?
Yeah, look, I mean, I'd hope that the RBA was going to look through a lot of that, the initial effects of it. The question was more about the second round effects and where people started to put prices up because of that, and you see. So I guess there's two effects of it. There's a direct effect of energy prices are higher, and so therefore the inflation goes up. But then the second effect is companies put up the prices of their goods because or services because energy prices are high, and so that sort of you get that double effect. And the first one, the RBA traditionally would look through, and most other countries would do the same. They'd say, no, look, we're not going to affect those energy prices, so don't take that. It's the second order effects. I mean, we were staring down the barrel of some quite significant inflation rises if they didn't come through with the some sort of cap on energy prices. The fact they have come through with that is a big positive, and so I think that's going to leave the RBA with rates lower than they would have otherwise been. It sort of helps that. How high is the peak going to be? And then the second issue was, then how does that flow into investment side? Now, I feel like you are back. I wasn't quite sure if I was monologuing there.
No.
I'm not sure about that internet issue. So that's going to affect the RBA. Okay, so what does that mean for investments and all the different stuff we've been talking about?
Yeah.
So the quality side is probably the number one things in terms of stocks. If you're looking for stocks, you want the companies that you think are going to be able to hold on to the margins, not the companies that performed well last year, which were the companies that often had quite weak margins but managed to get through price rises because of inflation. The second thing is from the second side of that is, do you want stocks, or how much do you want in terms of stocks? Now, I'm still of the opinion that we've got some reasonable earnings downgrades to come, and so stocks are still, we're still at quite low weights, and I think that's still the right thing to do. Later on this year, I do think we'll get a reasonable buying opportunity. So you do want to have your eye on there's some high quality names that are getting down in price that you can manage to buy at a price you won't see again. And so so within your portfolio, that's one side. Then in terms of growth stocks, so there's sort of three parts that they usually think about the market in terms of, you've got value stocks which are cheap, growth stocks which are more expensive but are growing, and then you've got your quality stocks which are earning good returns and high margins. And so I think the growth stuff will be the stocks you probably still should be getting into later on in the year after we've seen some market falls. But for now it's the quality side. Then in terms of in terms of Aussie versus international, I guess I'm more concerned about Australian stocks. I think Australian stocks, their earnings have held up a lot better to date, and we have seen the performance has actually been really good throughout a lot of 2022. And so Australia's gone from, if you break it into each individual component, so if you look at the Australian market overall, you can sort of go, oh yeah, it looks a little bit cheap relative to the world. But if you actually say, well, what do Australian banks look like versus world banks? And then they're sort of the top 10% of them have been more expensive. Then you go, okay, what about Australian industrials versus, and they go the same thing, not quite as expensive as banks, but in the top 20%. And then you go and say, well, what about resources? And you go and look at the resources, and they're sort of 20% more expensive than the international compatriots. And so what it means is the Australian market looks cheap because we've got lots of banks and lots of resources which are actually look cheap. They trade cheaper than the rest of the market. So whereas you break it into the three individual components, and the Australian market looks very expensive relative to where it has been in the past, and so I think there's more danger in terms of that. Okay, that's on one side. the one caveat to the Australian side is that if China genuinely is going to spark another building boom, then we'll do all right out of it. We won't be fantastic because I think a lot of that's already priced in, but it might not be as bad as I suspect it'll be on that side. And then on the bond side, I do think there's some value in bonds at the moment. So there's a bonds versus cash, or just park the money in cash and not run any risk, or do I put some money in bonds and take there might be some capital risk if interest rates or long-term interest rates go higher. But I do think that's sort of close to peaked. And so I think there's, for us, it's worth an investment in bonds still at the moment.
Yeah, very interesting. And it's worth just underscoring, isn't it, that bonds dropped, 16% in the US last year. Yeah. Tech stocks were 33%. The NASDAQ did the worst. Bonds didn't do that well. But then, of course, even the major indices also came down a lot further than Australia. But Australia didn't run up so much the previous year. So it's a little bit artificial to say that ours didn't drop as far.
Yeah. It's everyone has their turn as to being being the best and the worst, or certainly being towards the upper end and the lower end. I think Australia's had its turn of being one of the better performing stock markets, over 2022. So you can read that one or two ways. That means Australia is more resilient and is going to, and therefore it will do much better in 2023. Or you can read it as, look, we actually, we've run up and the rest of the world's fallen down, and you'll get the reverse happen at some stage. And I think traditionally Australia has been, because we do so much in terms of resources, when the world economy booms, the Australian economy really booms. And then when the world economy busts, the Australian economy really busts. And so we're caught in this weird part now where it's like, well, recession's coming. And so therefore, quite a high probability the Australian economy is going to bust, worse than the world, which is why we saw the Aussie dollar fall so far and the iron ore price fall so far. But then you're offsetting that with, okay, maybe China's going to get this property boom going again. And so, yeah. But
the key point to underscore is how exposed we are to what happens in the rest of the world.
Oh,
right.
Yeah.
We are a smaller trade exposed open economy, and therefore, actually, we don't have that many levers that we've got locally. We are really very much going to have to react to what happens in the US, Europe, China, Japan, even New Zealand, etc. Right?
Yeah, absolutely. And the other thing worth underscoring as well, I've probably underscored it a few times here, but it's worth saying again for anyone who hasn't heard, is that don't forget how exposed the Australian stock market is to both resources and banks. It's sort of 60% plus. Yes. Now, if I was a financial planner sitting in the US and you turned up to my office and I said, thanks for coming, Martin, I'm going to stick your portfolio into 60% resources and banks, I'd be fired for malpractice. Like that'd be lose my license. So that's the type of thing you'd see in these royal commissions where it's like, how could you possibly put so much of a client's money into two quite volatile sectors, whereas in Australia that's just the ASX 200. So it is worth noting that it is the Australian stock market is very different to a lot of other stock markets, and the world resources are less than 5%, whereas they're 5 or 6 times that Australia, and banks are less than 10, and they're 3 or 4 times that.
And my argument has always been that because of that higher risk quotient that represents, you should be getting a bigger return from investing in Australia relative to, say, the US or even Europe.
Yep, absolutely. And traditionally you have in the past, but the questions always comes back to, well, at current prices. That's you can look at the growth rates and all these things and try and extrapolate out what you think is going to happen. But the one thing you really can control is what price you're buying at. And am I buying at something that's cheap or not cheap? Yep. And so maybe we'll see this Chinese boom and the current prices will be justified and maybe they'll go higher.
Yep.
But if you don't see it, well, that Chinese boom is already priced in. And so if it doesn't come, So,
well, I appreciate that, Damien. I should just ask you to do one last thing, and that is just give us a quick reprise of Nucleus Wealth, the concept of the nucleus of the investment, because that's what you're focusing on, right?
Yeah, absolutely. So the idea for me is that when you're putting together a portfolio, you should have this sort of core of high quality liquid assets that sort of sit in the middle of your portfolio. Now, that the types of things I think sit in there is large cap shares, both international and Australian, government bonds, and cash. And so that's what we do. We do that around that. Then you can buy individual shares of smaller companies. You can buy small cap funds. You can hedge funds, corporate debt, property funds, whatever you want to do around that. But they're the types of ones where you might get a decent return over a cycle, and you can get and you only want a small part of your wealth involved in it. But sitting at the core, you want these safe, higher quality assets, and that's what we sort of focus on is doing those. And then the second part to Nucleus is what we really want to do though within those is the transparency, because we acknowledge that sunlight's the best cure for a lot of these things, and we have what we call, spoken to Martin before about it as painful transparency, where we show you every trade, every stock. Every holding is all within that, and it means that you can, if you're using, say, us as your core, is that then as you're putting your other assets around it, you can look and go, oh, actually, I wanted a lot of US tech, and they're a little bit underweight at the moment, so I'll buy a little bit more. Or at other stages of the cycle, you'll be like, oh, they've actually got lots of US tech, so I won't buy as much as what I might have thought.
Thank you, Damien. Well, you might be interested to know, I asked in the poll on the channel tonight, by the end of 2023, do you think the ASX will be lower than the start of this year, higher than the start of this year, the same as the start of this year, or too complex to know? And the results were 55% of people said that they think the index will be lower at the end of this year, 18% higher, 5% the same, and 22% it said it was too complex to know. Where would you sort of place your bet on those four scenarios?
Scenarios? By the end of the year.
Yeah, by the end of this 2023.
Okay, look, I think to me it's lower. I think lower in there's a point. There's definitely a point lower. We're probably lower by the end of the year. The only thing is this cycle has moved a lot faster than everyone's thought at all points, and so could I see a point where we go into a recession, in the middle of the year, and everyone's quite concerned, and then we see interest rates being cut, and then finally by the end of the year, the stock market suddenly said, "Hey," and central banks changed the word, and the stock market goes, "Hey, it's back on," and rushes back into equities. Yeah, I could see that happening. Yeah. But it's lower first, and so the only way it would get to a higher point, in my view, is via a low point. And I'd be surprised if it was higher by the end of the year. I think it's probably more likely to be, 18 months, but to 2 years, but maybe it moves faster. Yeah.
Yeah. And just on that, it's worth noting that the ASX 30-day, this is the cash, is talking effectively 3.975 November, December 2023, 3.98. So it's not really coming down this year, this financial year at all, this calendar year. And I think that probably mirrors a bit the US story as well, that rates will probably stay high most of this year unless we get a massive crash. And that's the unknown factor. So, probably sideways, probably down is probably the way to go, rather than seeing a huge amount of growth in this financial year, which again, it's part of the cycle. So we'll see.
Yeah. Yep. I think that's certainly this stage of the cycle. I'd be still urging caution, but getting your ducks ready for when you're lined up for when you do want to start investing again.
Have a plan for later, I think, is probably the key thing. Damien, Thank you very much. I appreciate you coming back off holiday and talking so lucidly for the last hour and a half. Really appreciate it. We'll do it again in 3 or 4 weeks' time when we do our monthly chat. But thank you very much. And we'll put links and things below if people want to follow up with the Nucleus Wealth or indeed the Water funds that you power and run. So thanks for that.
Thanks,
Have a good evening. Thank you very much. Right, so there you go, folks. I hope you found that useful. Very interesting conversation, Damon. Always like shooting the breeze with him. And just in terms of next week, well, next week you have me. I'll be on talking about the household finance stress and data from our surveys, which hopefully will be of some interest to you. The following week, we're going to have Senator Jared Rennick on, and he'll actually be debating some issues with John Adams, so that should be quite fun. So that's the 17th of January. And the week after that, Robbie Barwick's coming on to talk about some of the things that has been going on in his world, so that should be fun too. Before I go, I will just give you one last view of Luna. So she's been there all evening, hasn't moved, hasn't reacted at all to the thunder. Meteor has been under the desk the whole time, and occasionally grizzling when the thunder was too loud. So there you go. That's the status of play now. So thank you very much for spending some time with us this evening. Jason, thank you very much for the super chat there. Appreciate that. And thanks everybody else for comments and super chats, and enjoyed some of the other discussion there that we didn't actually put on the stream directly. So I wish you all the best. Have a happy new year. Happy 2023. Look forward to seeing you next week. And keep watching the other recorded shows during the week. We'll be on. Tarek and I will be recording a show this Friday. This is Martin North from Digital Finance Analytics signing off. See you next time. Cheerio.